Um, 18, I think that is the number we really just need to staple to the wall today. It's the magic number.
Yeah.
And we aren't talking about 18 days or, 18 weeks.
No, definitely not. We were talking about 18 consecutive quarters, which is, if you do the math, 4.5 years.
4.5 years, which in the tech world, that is basically a geological epoch. It's an eternity.
It really is.
We are talking about 18 straight quarters of doing the one thing that Wall Street loves more than oxygen, which is the beat and raise.
Right, the beat and raise. It is the absolute gold standard of public company performance. You beat the earnings expectations for the current quarter, and you raise the guidance for the future one.
Right.
And honestly, most companies struggle to do that 3 times in a row. Doing it 18 times suggests something very, very specific is happening under the hood.
It's exactly. So just to set the scene for you listening, it is February 24th, 2026. We are looking at Zeta Global. They just dropped their Q4 and full year 2025 results. And honestly, reading through this report, it feels less like a standard earnings filing and more like a victory lap.
It really does feel that way. Usually when we look at tech companies, especially in this marketing or ad tech space, you kind of expect them to stumble eventually.
Yeah, inevitably.
Right. There are market headwinds, execution errors, maybe a bad product cycle, or, a global pandemic. But to deliver 18 straight quarters of beating expectations, it suggests that this isn't just luck. It suggests a machine that is calibrated incredibly well.
And that is exactly what we are here to unpack in this deep dive today. We're going to take this machine apart and see how it works. So Zeta calls themselves the AI marketing cloud.
That's the elevator pitch, right?
And they help marketers acquire, grow, and retain customers using massive amounts of data and AI. But the core tension we need to explore here is the classic tech dilemma, right? Growth versus profitability.
The rule of 40 trade-off.
Exactly, the rule of 40. Usually you have to pick one. You burn cash to grow fast, or you slow down to make money. But the headline from this report is that Zeta claims to have just solved that dilemma. They are posting growth north of 30%, but they've also officially turned the corner into GAAP profitability.
Which is the holy grail for a software company.
It really is. So our mission today is to figure out the mechanics of this momentum. How are they doing it? Is it just accounting magic? Is it this AI they call Athena? We need to look at this very ambitious roadmap they've laid out for 2026 and all the way to 2028.
There is a lot to get through, mostly because the numbers are quite staggering once you dig into them.
Yeah, let's start right there. The beat and raise machine. We were talking about Q4 2025. What are the headline numbers that kept this streak alive?
So for the fourth quarter alone, Zeta delivered revenue of $395 million. That is a 25% increase year over year. But more importantly, for the beat narrative, that number exceeded the midpoint of their own guidance by $14 million.
$14 million over what they promised. Now, just playing devil's advocate here for a second. Is this just a case of sandbagging? Setting the bar artificially low so you can easily jump over it.
That's always a fair question. Companies love to lower expectations, but when you do it 18 times in a row and the beat is this substantial, 14 million isn't a rounding error, it stops looking like sandbagging and starts looking like supreme visibility.
They just know it's coming.
Exactly. They know exactly what is coming down the pipe.
And if we zoom out to the full year of 2025.
Total revenue landed at $1.305 billion. That is a clean 30% increase from the previous year. But here is where it gets fascinating, and this requires us to kind of act like detectives for a second.
I have my magnifying glass ready. What are we looking for in the numbers?
We need to look at the quality of that growth. If you just look at the 25% growth in Q4, it's impressive. But there is noise in those numbers. You have revenue from political candidates, and remember, we are past the 2024 cycle, but there is always activity. And you also have revenue from acquisitions like LiveIntent and Marigold's enterprise business.
Right, because buying other companies literally buys you their revenue. It can artificially inflate your overall growth percentage.
Exactly. But if you strip all of that away, exclude the political money, exclude LiveIntent, exclude Marigold, the organic growth rate in Q4 actually accelerates to 28% year over year.
Wait, hold on. So the core business, the stuff they built themselves entirely, is actually growing faster than the headline number suggests.
Correct. And that is incredibly rare. Usually, organic growth lags behind the inorganic acquisition growth. This implies that the underlying demand for their platform is not just stable, it is actively accelerating.
Wow. That actually brings us to a quote from the CEO, David A. Steinberg, that really jumped out at me in the report. He said, "This consistency isn't just luck or a single good product cycle." He called it the compounding power of our system.
That is a very specific choice of words, compounding.
Right. He went on to say it's about proprietary data that improves with every customer interaction, intelligence that sharpens with every decision. It sounds like a flywheel.
It is the exact definition of a data network effect. Think about it like a snowball rolling down a hill. In the AI world, whoever has the most relevant data wins.
Because AI is only as good as the data it trains on.
Precisely. Steinberg is arguing that because their system interacts with consumers constantly, the data gets better every single day.
Can we make that concrete for you listening?
Yeah.
Like, what does that actually look like in practice?
Sure. Let's say you interact with a marketing email sent through Zeta's platform. Maybe you click on a pair of running shoes, but you don't actually buy them.
Okay.
The system learns that. It learns your preference, your timing, your specific intent. That data feeds straight back into the AI.
So the AI gets smarter about me specifically.
Right. And because the AI is smarter, the next message they send you is more relevant. Maybe it offers a discount on those exact shoes a week later. Because the message is better, you are way more likely to buy.
Which gets a better result for Zeta's client.
Exactly. The client then spends more money on the platform, sending more messages, which in turn generates more data.
It's a self-reinforcing loop.
It is. And frankly, 18 quarters of beat and raise suggests the loop is actually working. It isn't just marketing fluff. The engine is actually getting more efficient as it gets bigger.
Okay, so the top line, the revenue is soaring. But I want to pivot to the bottom line, because this is where the story shifts from promising tech startup to mature industry giant. We mentioned GAAP profitability earlier. Why is everyone making such a massive deal out of this specifically?
Because in the software as a service world, profit can be a very squishy term. Companies love to talk about adjusted EBITDA.
Ah, yes, earnings before I count all the bad stuff.
Yeah, pretty much. Adjusted EBITDA is earnings before you count a lot of very expensive things, mostly stock-based compensation for your employees. It's basically a way of saying if we didn't have to pay our engineers in stock, we'd be making a fortune.
But in the real world, stock compensation dilutes the actual shareholders. It's a real cost.
Exactly. It's a real expense. But in Q4 2025, Zeta achieved positive GAAP net income of $6.5 million. That is a 1.7% margin. Now, 1.7% might sound small to some, but for a high-growth tech company to cross into positive territory on a GAAP basis is a massive psychological and financial milestone.
It means they aren't burning the furniture to keep the house warm anymore.
Correct. It signals that the business model is inherently sustainable without needing endless adjustments to look good on paper.
And it isn't just accounting tricks, right? They are generating actual physical cash.
Buckets of it. This is the other part of the maturity narrative. In 2025, their operating activities generated $199 million in net cash. That is up 49% year over year.
Nearly $200 million in cash. That is serious leverage.
And their free cash flow, which is the cash left over after capital expenditures like buying servers and equipment, hit $165 million, which is up 78%.
Wait, let me just check that math. Free cash flow grew 78%, while revenue grew 30%.
Yeah. That is what investors call operating leverage. It means for every new dollar they bring in, they are keeping way more of it. Their costs simply aren't rising as fast as their sales. That is the magic of software. When it scales correctly, you write the code once, you sell it 1,000,000 times.
That perfectly aligns with what their CFO, Chris Greiner, said. He used the phrase durable, predictable, and profitable growth. It feels like they are really trying to distance themselves from the whole growth at all costs era of tech.
They absolutely are. Greiner framed the transition into 2026 as the year where revenue growth eclipses 30% while turning GAAP net income positive for the full year. That is a notoriously difficult combination to pull off.
Because usually if you want 30% growth, you have to spend incredibly heavily on marketing and sales to get it.
Exactly. Zeta is claiming they can have their cake and eat it too.
So how are they doing it? We talked about the compounding system, but let's look under the hood for a minute. What is the engine here?
The engine is really twofold. It's the technology, specifically Athena, and the customer strategy.
Let's start with Athena, because it sounds like a superhero or, well, a Greek goddess.
In the marketing world, it kind of is. Athena by Zeta is their AI interface. The press release describes it as an interface that lowers the barriers to enterprise-wide adoption.
Which translates to it makes the software much easier to use.
Basically, yes. But in enterprise software, ease of use is everything. If you have a powerful database which Zeta definitely has, but it takes a team of PhD data scientists to extract any insights from it. It's a massive bottleneck.
It's like having a Ferrari, but you need a Formula One pit crew just to start the engine.
Great analogy, yes. Athena seems to be the layer that allows a regular marketer to just ask questions and get answers. You can type in, "Who are my most loyal customers?" Or, "Build me a segment of people interested in buying SUVs next month." And the AI just does the heavy lifting.
That positions Zeta as an AI disruptor then.
Right.
They aren't just providing tools, they are providing active intelligence.
Exactly.
Yeah.
And that intelligence seems to be convincing big companies to spend way more money.
I was actually looking at the customer metrics on that note, specifically this super scaled customer category.
Yeah, this is a critical metric for investors to watch. Zeta defines a super scaled customer as one that generates more than $1 million in trailing 12-month revenue.
Okay, so these aren't mom and pop shops, these are the whales.
No, these are massive enterprises. In Q4, that count grew to 184 customers. That is an increase of 36 customers, or 24% growth year over year.
So they added 36 separate companies, paying them over $1 million a year. That's highly significant.
It totally validates the land and expand strategy. It's one thing to get a customer in the door with a small contract. Maybe they just use Zeta for some basic email marketing. But it is another thing entirely to grow them into $1 million account.
It proves that they're finding massive value.
Right. It proves that once customers start using the platform and Athena, they find value and they increase their spend. They start using the data cloud, the acquisition tools, the retention tools.
It's sticky. Once you're spending $1 million and it's integrated into your workflow, you aren't leaving.
Well, extremely sticky.
Yeah.
And they also mention scaled customers generally, which are those over 100K in revenue. That pipeline seems very healthy too, implying there's a deep bench of clients ready to graduate to that super scaled status.
Which creates a very predictable revenue funnel. And predictability is exactly why the stock market rewards companies with high multiples.
Absolutely.
Speaking of predictability, let's look at the future. They didn't just drop the mic on 2025. They laid out guidance for 2026 and the Zeta 2028 plan. Let's start with the immediate future. What does 2026 look like?
It looks like more of the same, but just bigger. They raised their full year 2026 revenue guidance to a range between $1.749 billion and $1.762 billion.
That is up $25 million from their prior guidance.
Right. It represents 34 to 35% growth. And again, you have to keep in mind, 2026 is a non-election year. There are no presidential campaigns buying up ads. Even if you strip out the political cycle money and the acquisitions, they are projecting organic growth of 20 to 21%.
That is incredibly robust for a company of this size. And profit.
Adjusted EBITDA is expected to hit around $390 million. That is roughly 40% growth. And free cash flow is raised to about $231 million. So the cash generation machine is just accelerating. They're going to have nearly $250 million in free cash just sitting there.
Which gives them dry powder to buy more companies or invest even heavier into AI.
Exactly.
Okay, but here's where it gets really interesting to me. The Zeta 2028 plan. Usually, tech companies are very hesitant to look 3 years out. The world changes way too fast. But Zeta just planted a flag.
It is a very bold flag. They increased their 2028 revenue target to at least $2.3 billion.
$2.3 billion.
Yeah. That implies the compound annual growth rate, a CAGR of 23% from 2024 through 2028. And note that this target accounts for the completion of the acquisition of Marigold's enterprise business. So they are baking that integration right into the numbers.
But the profitability targets for 2028 are even more aggressive than the top line.
They really are. They are targeting adjusted EBITDA of at least $573 million. That implies 25% margin. And they expect free cash flow to be at least $371 million.
Over $250 million in free cash flow. That transforms the profile of the company completely.
It absolutely does. It moves them from a growth stock where you basically buy it for the potential to a true cash cow that is still somehow growing. That is a very powerful combination for valuation. It's essentially what companies like Adobe or Salesforce eventually became.
Okay, we've been very positive so far because the numbers are objectively great. But we have to keep it real. This is the Real Talk section of the Deep Dive. We are not the Zeta fan club. We are analysts. So what could go wrong? What are the risks actually buried in the fine print here?
Well, the report includes a safe harbor section for a very good reason. There are real risks here. First, you have the external threats, macroeconomic trends, interest rates, inflation. Zeta is carrying some debt. Their long-term borrowings are around $197 million.
That's manageable given their cash flow, but still, a risk.
Right. If interest rates spike or the credit market suddenly sees up, that debt becomes a lot more expensive. And remember, their customers are businesses. If the broad economy tanks, marketing budgets are usually the very first thing to get cut.
It's the easiest line item to slash. Stop the ads, save the cash.
Exactly. Now, Zeta would probably argue their AI makes marketing more efficient, so it should be the last thing cut. Basically, you need us to survive the downturn. But that is a theory until it's actually tested by a deep recession.
Fair point. Then there is the technology risk. Generative AI.
The ultimate double-edged sword. The report specifically lists the impact of new generative AI capabilities as a risk factor. Right now, Zeta is riding the wave. They have Athena, but Gen AI is moving so incredibly fast.
Right. What happens if a competitor, or worse, a massive player like Google or Microsoft, introduces a tool that makes Zeta's Athena look completely obsolete?
That is the classic innovator's dilemma. You have to disrupt yourself before someone else does. If Google decides to just give away these capabilities for free inside their ad platform, Zeta's entire value proposition could take a massive hit. That 18-quarter streak could end very quickly if the tech landscape shifts under their feet.
And finally, there is the data privacy angle. This is the one that always worries me with ad tech. The report mentions the ability to collect data online and regulations from inbox service providers.
This is huge. Zeta relies on trillions of consumer signals. But where do those signals actually come from? Cookies, email opens, tracking pixels.
And all of those mechanisms are currently under attack.
Right. Apple basically killed the cookie on the iPhone. Google is constantly messing with Chrome tracking. Governments worldwide are passing stricter privacy laws.
And the inbox service providers, that basically just means Gmail and Outlook.
Exactly. If Gmail decides tomorrow we are going to block all marketing emails from this specific type of sender, or we are going to make it impossible to track if an email is actually opened, Zeta loses a massive source of their data. Their compounding loop suddenly slows down.
So they are building a massive, impressive castle, but they are building it on land owned by Google and Apple.
To some extent, yes. Zeta tries to mitigate this by owning first-party data that consumers give directly to them or to their publishers. That is a big reason why they bought Live Intent. It gives them a direct line to email data that doesn't rely as much on third-party cookies. But the risk of signal loss is just always going to be there.
So it's not a completely risk-free path to $2.3 billion. But looking at where they stand today, February 24th, 2026, the narrative is incredibly strong.
It is. If we synthesize everything we've discussed, Zeta Global has managed to achieve a balance that very few software companies ever reach. They have high growth, over 30%, combined with real GAAP profitability and massive cash flow generation.
They've built a real moat using proprietary data and AI that has allowed them to beat expectations for 4.5 years straight.
And they are loudly signaling that they believe the AI marketing cloud is not just some niche tool, but the future operating system for all enterprise growth.
Which brings us to the big one. So for you, the listener, whether you are an investor, a marketer, or just a tech watcher, Zeta really is a masterclass case study in execution. But I'll leave you with a thought based on those 2028 targets.
Go on.
If Zeta plans to hit $2.3 billion in revenue with a 25% EBITDA margin, they're betting heavily that AI won't just support marketing, but effectively take it over entirely. They're betting that the super-scaled customers will hand over more and more of their actual strategy to the machine.
That is the direct implication, yeah. Less human guessing, more algorithmic certainty.
Yeah. So the question for you to mull over is this. Do you believe the AI marketing cloud is the future infrastructure of all advertising? Is the era of the Mad Men creative agency officially dead, completely replaced by the math men and their algorithms? Because if Zeta actually hits these targets, the math is definitely winning.
A fascinating battle to watch. The math men are definitely up on the scoreboard right now.
They really are. Thanks for diving in with us. We'll catch you on the next one.